Hello, and welcome to today's stream. So we're going to be kicking off today talking a little bit about why property is the best investment out there. So a question I often get asked is property a good investment for you, or is property a good investment for me at this given time? And today we're going to be answering that age-old question, is property a good investment vehicle for you at the minute? So it should be a really good session. I'm really looking forward to it. Now what we're going to do is we're first of all going to, can't see me? I seem to be live online. You may want to check again. Okay. Essentially what we're going to be doing is we're going to talk a little bit about why property is a good investment vehicle in today's current market, why property is an amazing investment vehicle actually. So the first thing we're going to do is we're going to kick off talking a little bit about all the investment options that you currently have out there in the marketplace. So you'll notice if you've been researching and looking around and investing exactly as I did many years ago, you're going to be looking at what investment vehicles there are for you and which you feel may be the most suitable. So I started looking at stocks and shares. I tried to get involved in stocks and shares. That was a mess. I lost money. The problem with stocks and shares is very few people as a percentage actually end up making serious money in there. About 70 or 80% at least tend to lose money. There's only a small group of people that actually make money over time as a whole. A lot of people might make money for a period, but then they tend to lose it. And there's a lot of pros and cons around stocks and shares trading. Primarily, it's a very volatile industry, a very volatile market, which means although you can make money quickly, you can equally lose money quickly. And there's many a man and many a woman that has become a millionaire and broke in a very short space of time because of Wall Street and because of the stocks and shares market. Good evening, by the way, everybody. Cool to see you. And then you've got some other investment vehicles. So if you consider people like ISAs, so this is the government incentivized or the bank incentivized scheme, where you put your money in there, you get 1% a year, and you can put in a certain amount and it's tax-free, the profits, and they make it sound brilliant. Realistically, the returns are next to negligible. If you consider right now in the UK, the current rate of inflation, or the consumer price index as they call it, is somewhere between 2.5% and 3%. Okay, hey Sam, awesome to have you in, man. So somewhere between, and John, awesome to have you in. So it's somewhere between 2.5% and 3%. That's the current rate of inflation that you're facing here in the UK. Now, if you take a look at what you're getting as interest in the bank, it is around 0.1%. So what that means is the consumer price index is a reduction in the value of your money every year by around 2.5% to 3%, but you're making 0.1% interest a year, which means you're losing somewhere around 2.4 to 2.9% interest or value on your money in the bank. So essentially, if you had 100 grand in the bank, you might as well every year draw out about £2,500 and set it on fire, because at least you get warmth from it, because right now you are getting nothing. So money in the bank is not a good investment vehicle. Let me be 100% clear with you. The money is very liquid and easily usable, but it is not an investment class. I don't care what you say, it is not. You are losing money, it is a liability and not an asset. Whereas if you stick money in an ISA, okay, you can get yourself a massive 1%, huge return, but you're still losing 2.5% based on inflation or the consumer price index. So that again means that you're not actually making any money. Now, of course, in stocks and shares, you have the ability to make a bit and lose a bit. So there is some opportunities to make a little bit of money, but in reality, you're probably going to find that you lose money. Now, you've got other investment vehicles like gold or silver, or investing in any other commodities like oil. So you've got a plethora of different investment vehicles you can put money into. But either they're not very liquid, or again, it is very similar to playing the stock market, where the values are going to be trending up and down quite rapidly, which means you're kind of gambling and hoping you exit at the right point or enter at the right point. So it's a little bit of a tricky game. Okay, and you either have to be very well skilled or very lucky. This is my experience within commodities trading. Same with forex trading, currency trading. It is exactly the same. You've got the same ups and downs, which means you have to get in and out at the right time to make this make sense. Now, some of the things that those don't have is a lot of them don't have something called cash flow. Okay, this is your residual income you get from your investment. And this is something that property has, and I'll go through this in a minute, or in just a minute. So if we start off with some of the benefits of investing in property. Okay, so obviously you understand that there's a whole bunch of investment class, and then you've got property. Some of the benefits of why investing in property is such a brilliant thing to do is not only do you get your capital growth, so an increase in value in time, and I'm going to demonstrate how all of these work for you in just a minute. You also get something called cash flow. Okay, now cash flow is basically a residual income, an income you get whether you wake up and get out of bed or not. That money will continue to come into your bank. It's a passive income. Okay, and this is cash flow. Now you don't tend to get that with most investment class either. You do get with some, but then you do tend to find there's a payoff in value, etc. The third thing is you get the ability to leverage. Okay, the banks will actually lend you money to build a property portfolio. They will lend you money to invest in property, invest in real estate, which is fascinating because you try and ask the bank if they will lend you money to buy commodities or stocks and shares, or invest in an ISA, or even stick money into a pension. The banks will laugh at you. They'll be like, look, I'm sorry, we're not going to lend you money to go stick in one of these reckless investment classes. Whereas if you say, I want to invest in property, like, yeah, sure, we'll pay 75% of the way for you. Okay, 75%, that is a big deal. Why do you think the banks are willing to do that? Okay, do you think the banks are stupid? Well, I personally don't think so. I mean, the investment banks might be a bit gung-ho, but I don't believe they're stupid. Okay, they've been around for millennia. Well, certainly many, many, many centuries. I'm sure they came in the 1800s. Okay, so banks have been around for a very long time, and they've had that survivability because they have a bit of an understanding of the value of money and strong, solid asset investing. Okay, i.e. property. So so that's some of the things that you have. Now let me give you a demonstration about how some of these work and why they're so cool. Okay, so what I'm going to do is I'm just going to flip onto my iPad, so you're going to be able to see my iPad here in the background, and I'm actually going to go through it with you sort of step by step, so you can have a bit of an understanding. So the first point is a little bit on what we call capital growth. Okay, capital growth. Now, if you take a look statistically in the UK, check if it's the right one. I've got a camera of a camera, so that should be the right one. So statistically here in the UK, you've got, so all properties in the UK, as an average, every 8 to 10 years double in value. As an average here in the UK, okay, every 8 to 10 years double in value as an average in the UK, which is fantastic. Now, if you doubt that, I urge you, go take a look back in the records all the way back to the 1950s. Okay, in the 1950s, when the property records began, you'll notice the consistent trend of ups and downs in the marketplace. Now, I say as an average because depending on when you're looking, what segment of 10 years you're looking, you might notice that property values have gone down, or you might feel like they've gone the same. However, you might also notice that they go absolutely skyrocketing. Now, on some of our sessions, you'll actually see our presenter graph of this, where you see, as an example, between 1988 and 1998, property values pretty much went down a bit and went back up a bit, and they were about the same. Kind of similar to most people here in the UK who live further north. Okay, obviously in London it's a little bit different, and the south of England is a little bit different, but up in the north of England, a lot of places have only just recovered from the 2007-2008 crash. Okay, now if you look at this graph between 1998 and 1988 and 1998, the property values were roughly the same as an average. Okay, now if I'd have said to you in 1998, property prices double in value every 8 to 10 years, you would have laughed at me and said, no way. Okay, because you would have looked at the last 10 years. However, if you look at the 10 years thereafter, it goes from the average that it was, and it actually triples in value between 1998 and 2008. Okay, it triples in value. So when I say property prices as an average double, I mean as an average. Okay, and just look at the facts. You're more than welcome to take a look online. You're sitting in front of a computer or screen now. You can easily drop off and take a look, or when you finish, you can easily drop off and take a look. Okay, so when I talk about doubling on average, I mean that. Now let me show you something as to why this is very cool. Because let's just say you start your investment journey and you have 100K and you have 100K cash. 100K cash. Now this should hopefully be coming up in my top right corner. I've got a little bit of a delay on YouTube, so please bear with me. Okay, and then you find a property that you like the look of. Okay, and you say, look, I really want to buy this property and the house is worth 100K. And you go, okay, brilliant. So I'm now going to buy this house with my 100K cash that I've got over here. I'm going to buy the house. Nice and simple. And then in 10 years time, as an average, here in the UK, property prices double. Even if it doesn't quite double, you'll still see why it's amazing. As an average, let's just say this house has done its usual trick and it doubles, and it's now worth 200K. And then a further 10 years down the line, the house is now worth 400K, because again, it doubles again from 200K to 400K. By the way, if you doubt this, try and speak to somebody who knows what they bought a house for in the 1970s, 1980s, and see how much the house is worth roughly now. It will massively confirm that for you very, very quickly. The amount of people I know that bought houses for £2, £3, £4, £5,000 back in the 80s that are worth 3, 4, 500,000 now. Okay, it's wonderful. So yeah, so the house now is at this point is worth 400k 20 years down the line. Now, if you were to then sell the house and take back your original investment of 100k, you'd be making a net profit. I appreciate I'm standing right in the way. A net profit of 300k. Okay, £300,000 net profit. Now, this is obviously a pre-tax profit. You're going to have taxes to pay on that. But please understand that you've made this 300k by doing no extra work over the next 20 years. Now, if you'd like to make 300k over 20 years without having to do any extra work, just do me a favor, just give me a yes in the chat, or just give me a high five, or give me a like, because this is really cool. I love this stuff. This is very interesting. Okay, so this is what we call property or capital gains, capital growth. So the value of the property has increased in value over time. That's wonderful. Okay, now the second thing I'm going to discuss with you is cash flow. Okay, cash flow. Now, how cash flow works is basically what you tend to receive from your property is you tend to receive something called rent. Okay, obviously investment properties when you rent them out. So you receive your rent, and let's just say your rent on this property is £600 a month. Okay, nice and simple, £600 a month. And off the back of that, you're going to have your management fees, okay, which is typically 10%. So this is where you pay for your lettings agents to manage the property, because they're all qualified, they understand how to deal with tenants, they're probably in the local area to your investment property. So you've got to pay typically 10% of your rent to them, which equates to about £60. Okay, then you've got something called MO, or operating expenses. Now this covers maintenance and insurance and voids, which is when a tenant moves out before a tenant moves in. Okay, before another tenant moves in. This is called a void period. We typically allow around 10% for this as well, which equally is £60. Okay, and then you're going to have a mortgage cost. Okay, a mortgage cost, because in all likelihood you're probably going to leverage, and I'll come into leverage in just a second and why it's so important. So let's just say your mortgage cost on this property is £200, just for the ease of numbers. Okay, £200. Now what that means is at the end of every month you have your £600, and then you take away your management, your operating expenses, and your mortgage fees. So that, if my math is correct, leaves you about £280 per calendar month, PCM, per calendar month. So this over here, this is your cash flow figure. Now the beauty about this is if you box smart, if you do this right and build your portfolio intelligently, you will be earning roughly this amount of money every single month for the rest of your life, for all of the time you own the property. As a matter of fact, as the rents continue to go up, okay, the mortgages don't tend to move very fast, which means that your cash flow continues to go up. So over time, you continue to earn more and more money from your portfolio, which is a huge one. So this is cash flow. Cash flow is a huge advantage. And this is where property outstrips the vast majority of investment classes, because the vast majority of investment classes don't have this in place. Okay, it's wonderful. Okay, so that's the next thing, which is cash flow. Then the third thing, now we're moving a little bit into some more of the interesting stuff. Okay, and this is the leverage I was talking to you about earlier. So let's just say you have the same 100k cash. Okay, so you have the exact same starting pot. Now please understand this might be an equity that you release from your house, it might be another investment. There's a whole heap of places where you can have this sort of money. Okay, and it might not be 100k, it might be 20, it might be 50, whatever it is, it's a starting pot. Okay, so you've got your 100k cash and you find the very same house and you think, look, I really like this house. The house is worth 100k, so that's the value of the house. It's worth 100k. Now the mortgage lenders or mortgage companies will typically lend you around 75%, and getting mortgages is not particularly challenging. Okay, you get a decent mortgage broker, they'll help take care of this. They'll typically lend you about 75% of the purchase of the property. Okay, now that means the mortgage amount on this house will be 75k, which means the money that you have to find is something called deposit, okay, which is the remaining 25%, which is 25k. Now, please understand, I am aware of the fact that there are some other fees you need to cover: stamp duty, insurance fees, legal fees, brokerage fees, all of that sort of stuff. But I'm very interested in getting you to understand the concept, because when you get the concept, everything else makes sense. Okay, you can input the numbers after that. Now, if you only need 25k to be able to buy this property, and you actually start with 100k, that means you can buy a total of 4 properties at 25,000 each of the same type of property, which means instead of having one house, you end up with 4. I will show you why that's valuable in just a second. Okay, so what you end up with, 4 houses at 100k, 4 mortgages at 75k each, and 4 deposits at 25k each. So your portfolio is 400k, your mortgages are 300k, and your original investment is 100k. Nice and simple. Okay, now this is where we start to take things to the next level. So if you move this down the line 10 years, and the property price doubles, as it tends to do in the UK, and the house is now worth 800k, okay, or your portfolio is worth 800k, it's a nice win. Now, the types of mortgages we tend to use for investment mortgages are something called interest-only mortgages. Okay, you've got 2 different types of mortgages, capital and interest interest-only. Capital and interest mortgages are mortgages where you not just pay the interest every month, but you also pay down a little bit on the mortgage, so it reduces from 75k down a little bit every month. Now, we always do interest-only mortgage because the primary purpose of investing in property is for cash flow. That is the primary purpose. And by moving into a capital and interest repayment mortgage, you are having to pay more every month and therefore sacrificing your cash flow, which doesn't make sense. And you'll understand why it doesn't make sense in a minute, because paying off the mortgages early doesn't really add up, doesn't compute. You will see. So basically what I'm saying is your mortgages will likely be around the same, because they're interest-only mortgages, at 300,000 in 10 years' time. And your original investment pot is still the same, 100k. Now, we go a further 10 years down the line, and your portfolio is now worth 1.6 million pounds. Okay, and it all starts with a 100k investment, bear this in mind. So 1.6 million pounds, your mortgages will still be the same, because they're still the same interest-only mortgages. And your investment pot is also still the same, because it's still the same 100,000 invested. Now, if you decide at this point you're going to sell off your portfolio, okay, you do your 1.6 million, you pay off the mortgages, which is 300,000, brings us down to 1.3 million. Then you take back your 100,000 original investment. That means you make a 1.2 million pounds pre-tax profit. Pre-tax profit. Now this is wonderful, because this then shows you, the power of why leverage is important over time. Now I often get people say, but why do we do interest-only mortgages? Okay, let me show you exactly why. Because if you have a house, and it's worth 100k, okay, so the value is worth 100k, the mortgage is worth 75k. Okay, now the percentage debt ratio, so the percentage of this property that is debt, that is mortgaged, okay, is 75%. Now 10 years down the line, the house is worth 200k, but your mortgages are still only worth 75k on an interest-only mortgage, which means your debt ratio has dropped by half to 37.5%. Okay, interesting, right? Now if we go further 10 years down the line, and the house is now worth 400k, but your mortgage is still only worth 75k, which means your debt ratio has gone down to 18.75%. And so on and so forth. You go another 10 years, it's worth 800k, 75k, and then you're sitting at 9.375, I think it is, percent. Okay. Now the interesting thing is, what are you noticing is happening to the percentage debt in the property? Okay, and of course that is, it's going down. Okay, it's going down. The percentage debt is going down, which means the value of your debt is going down. Now, who's busy paying off your mortgage? Interesting question, right? And this is what's so important about what we do, and this is so important about why we invest in property. Because if your money is sitting in the bank, it is being eroded by inflation. Whereas inflation in this instant is actually what is increasing the value. Okay, it's increasing the value of the property, not necessarily the property itself, but it's decreasing the value of the pound, which then means the stagnant value item is worth more pounds. It's still worth the same as a total value, but it's worth more pounds itself. Okay, because the value of the asset maintains the same, the value of the pound decreases. Now it's really interesting because this in this instance works in your favor, because whose money is this? Okay, it's the banks, right? So essentially every 10 years, the bank's debt is being eroded by 50% because it's being halved every 10 years. So the value of their debt is being eroded by 50%, which is wonderful. Okay, I think this is exactly why we invest using an interest-only mortgage. Because why would you sacrifice your cash flow, which would slowly reduce this? Don't get me wrong, over 40 years you probably not owe the 75,000, but why would you have sacrificed the cash flow, which is what you would be using to get out of your job in the first place? That's the purpose of investing in property, is to replace your income and get to what we call financial freedom. Okay, which is very cool. Now, so I'm trying to think. There's one example I thought would be very useful, which is leverage versus growth, and that's kind of what we've gone through here, which is explaining why leverage and growth together is very, very powerful. Now let me show you guys a quick example of a deal, okay, a property investment deal that you should be looking to achieve. Now this depends on where you're investing, what types of investments, if you're investing further north, what sort of pot you've got, where you get access to deals, whether you have a team of builders, etc. within the area. But I'm going to show you an example deal that you can typically achieve in the north of England. And I love this because you get these in the north. So a typical deal, so a typical deal is what we call a buy, refurbish and refinance house. Okay, buy, refurbish and refinance. And refurbishing is a great way to be able to buy something for a discount that you can then add value to. So basically, if you find a property and the value of the property is 60k, that's what you buy it for, and then the refurbishment, because of course you're refurbishing the house to add value, is worth somewhere around 20k, and then all of your other fees and legal fees and costs come into around 5,000, which means at this point you've invested around £85,000 in the house. Now the beauty is the bank will typically lend you 75% of the deposit, okay, and there is many ways in which you can raise finance. As a matter of fact, on our 3-day training, we talk you through 20 different ways of raising finance, so you can actually cover the cost of your refurbishments and legal fees and all that sort of stuff using other people's money. Really interesting stuff. I urge you guys to come along. Okay, so you've invested a total of 85k to this point. Now at this point, you go back to the bank, and of course, the house that needed refurbishing is what we call a smelly house. Okay, and now you've got a house that's been refurbished, and of course it is sitting at its primal value, its optimal value, because it's been done. So the house is now worth, as an example, £100,000, which, let me assure you, you need to know this figure before you buy the house, because otherwise you will not know if it's a deal. Okay, we actually go through how to do that on the training as well. Okay, now the bank lends you 75%, as per usual, they lend you 75%, but now of the new value of the house. And if you've only spent 85k in the house, and they've given you back 75k, that means all you have invested in the house is £10,000. Okay, this is why we love property. Okay, this is why I love it, because this is what enables you to build your portfolio with not a large pot of cash. And the beauty about this property is we'll typically give you, give or take, around £200 a month cash flow, net income, which is very exciting. So that is essentially what I wanted to cover with you guys today, which is property a good investment? So hopefully you guys have seen that property is an amazing investment vehicle, vastly better than anything else that you're going to find out there. And I'm going to push this out to everybody on social media to see if you guys have any questions. And if you guys have any questions at home and you're catching this as a recording, please do drop a message in the chat. Myself or the team, we do monitor this, and we're more than happy to answer any questions you have. So does anybody have any questions off the back of this? I'll give you guys a couple minutes to allow time for lag. If not, no problems whatsoever. I can genuinely say it has been a wonderful stream. Hopefully you guys have got some value from this. I urge you, please like, please subscribe down below, join our channel, help us continue to grow as a business, help us continue to grow as a channel, so we can continue to share our knowledge and our wealth of information with you guys, so that you can build a brighter future for yourself by building a successful property portfolio. Right, okay, looks like there is no questions. So that brings us to an end of the stream. I just want to say thank you very much, each and every single one of you guys, for your time, and I look forward to seeing you again. Goodbye.